Hey, welcome back to my channel, and today we've got a hot topic to discuss, and it affects not just investors but the entire financial market. We've been talking about the impact of rising interest rates on nearly $2 trillion of junk-rated debt. And if you're new here, don't forget to hit that thumbs up button so I can make more videos for you. Now, understanding this junk-related debt, let's begin with the basics. Junk-rated debt, also known as high-yield debt, is debt issued by companies with credit ratings below investment grade. These companies pay higher interest rates to compensate investors for the increased risk of default. Now, these bonds are often sought by investors looking for higher yields. So, what's the big deal about rising interest rates? Well, the US Federal Reserve has been hiking interest rates, making it more expensive for companies to borrow money. This creates a domino effect. With higher interest rates, companies face challenges servicing their existing debt. And companies need to allocate more funds to cover interest payments, which can strain their cash flow. But it's not just servicing the debt. Refinancing becomes tricky as well. And companies with debt maturing in the near term may struggle to secure favorable terms for refinancing. Now, rising interest rates are often a sign of a stronger economy, but there's a catch. And it can lead to inflation and increased competition for resources, eroding profit margins, as we see in the housing market. Now, here's the crux of the matter. Default risks are looming large. And companies in sectors like energy, retail, and healthcare are particularly vulnerable. Now, energy companies, often highly represented in the junk-rated debt market, are grappling with oil price volatility. Rising interest rates could push some closer to default. And retailers facing disruptions from e-commerce and the pandemic are in a tough spot right now. So rising interest costs might be the final blow for these unable to adapt. And healthcare companies, especially in pharmaceuticals and biotech, are sensitive to regulatory changes. Now, higher interest rates could further pressure these firms. Now, what happens when these companies default on their debt? It has broader implications, including the risk of a contagion affecting in the credit and equity markets. And investors and lenders are also at risk because of this. Now, investors may face losses and lenders could see weakening financial health. But there's hope, because companies can take steps to mitigate these default risks. Now, this might include debt refinancing, strengthening cash reserves, and focusing on operational efficiency. Now, it's a tough road ahead, and it requires careful planning and strategic decision making. Now, if you found this video helpful, please give me a thumbs up and check out my next video right here.